Understanding the global monetary system. Firstly, what is global monetary system? The global monetary system is the framework that governs how money is created, valued, exchanged, and transferred across countries. It influences trade, investment, inflation, and economic stability worldwide. As of today, global financial flows exceed 6.6 trillion United States dollars per day in foreign exchange markets alone, making this system one of the most powerful forces shaping the world economy. 1. Now, how money moves and is managed across countries. Money moves internationally through trade payments, foreign investment, remittances, aid, and financial markets. Global trade in goods and services accounts for over 32 trillion United States dollars annually. International remittances reached approximately 860 billion United States dollars in 2023, a vital income source for developing economies. Cross-border capital flows include foreign direct investment (FDI), which stood at around 1.3 trillion United States dollars globally. These flows are managed through banking systems, payment networks like SWIFT, and national regulations designed to control capital movement and financial stability. 2. Currencies and exchange rate regimes. Every country issues its own currency, but not all currencies play the same role globally. The US dollar dominates, accounting for about 88% of all foreign exchange transactions. Other major currencies include the euro, 31%, Japanese yen, and British pound. Countries adopt different exchange rate regimes, which determine how their currency's value is set. Floating exchange rates, for example. US, EU are determined by market forces. Managed floats involve occasional central bank intervention. Fixed or pegged systems tie a currency to another currency or basket. 3. Fixed exchange rate systems under a fixed exchange rate regime. A country pegs its currency to a stronger one, usually the US dollar. Examples include Hong Kong, which has maintained a dollar peg since 1983. Fixed systems provide exchange rate stability, helping trade and investment. However, they limit monetary independence and require large foreign exchange reserves. To defend a peg, central banks may need to spend billions of dollars from reserves during periods of market pressure. 4. Central banks and monetary policy. Central banks are the backbone of the global monetary system. Key institutions include US Federal Reserve, European Central Bank (ECB), Bank of England, People's Bank of China. Their primary tools include interest rates, open market operations, reserve requirements, for example. Between 2022 and 2024, the U.S. Federal Reserve raised interest rates to a range of 5.25 to 5.50% to control inflation. Central banks collectively hold over 12 trillion United States dollars in foreign exchange reserves, with China holding the largest share. 5. International monetary institutions. Several global institutions coordinate and support the monetary system. International Monetary Fund, IMF, 190 member countries, provides emergency loans and policy advice, has lending capacity exceeding 1 trillion United States dollars. World Bank focuses on development and poverty reduction, commits over 100 billion United States dollars annually in financing. Bank for International Settlements, BIS, acts as a central bank for central banks, facilitates monetary coordination and research. These institutions aim to reduce financial crises and promote stability. 6. Global money flow and financial markets. Global money flows through foreign exchange markets, bond and equity markets, banking systems. The foreign exchange market is the largest financial market in the world. Daily trading volume exceeds 6.6 trillion United States dollars, operates 24 hours a day across global financial centers. Capital often flows from developed to emerging markets in search of higher returns, but can reverse quickly during crises, causing volatility. 7. Historical context. The gold standard 80s, 70s, 1930s. Currencies were backed by gold, provided long-term price stability, collapsed due to limited flexibility during economic crises. Bretton Woods system 1944 to 1971 pegged currencies to the US dollar. Dollar was backed by gold at 35 United States dollars per ounce. Ended in 1971 when the US suspended gold convertibility. This marked the beginning of today's fiat currency system, where money is backed by government trust rather than physical assets. 8. Current challenges in the global monetary system. The modern system faces multiple challenges. Currency wars. Countries may weaken their currencies to boost exports, increasing global tensions. High global debt. Global debt exceeds 310 trillion United States dollars, over 330% of global GDP. Cryptocurrencies. Bitcoin market capitalization has fluctuated between 500 billion United States dollars and over 1 trillion United States dollars. Cryptos challenge traditional money but face regulation, volatility, and scalability issues. Geopolitical risks. Sanctions and trade conflicts are fragmenting global financial integration. In conclusion, the global monetary system is a complex yet essential structure that connects nations through money, trade, and finance. From central banks and exchange rates to international institutions and digital currencies, this system continues to evolve. Understanding it is crucial for grasping how global economic power is exercised and how future financial stability will be shaped.